skipping ahead a little bit in your book, which
Yeah.
by the way, I thought was great. So one of the chapters in your book is focused on selecting a coherent investment universe, which is sufficiently large so as to capture all of the orthogonal dimensions of risk and return, but reduced to the point where there is a minimal amount of overlap between the
Right.
different bets in the portfolio. So the ETFs that you just launched, are they meant to be these sort of orthogonal constituents to a portfolio?
They are our first suite of products. They're labeled convexity, U.S. equity convexity products, and what we're trying to do there really is go from a normal distribution of an equity risk premium or relatively normally distributed equity risk premium. And S&P 500 is our core equity premium benchmark that we're using at Simplify. And we're trying to say, can we modify the moments of the distribution to create something that is pretty orthogonal to the core risk premium? So kind of what you would expect out of alternative risk premia, where you're taking on higher moments. But at Simplify, we're trying to really preserve the core equity risk premium when we do this. So we're always invested around 98% in U.S. equities. And then we have this 2% convexity overlay that's meant to really chop off left tails, add to right tails, and add skew and co-skew and these higher moments while still giving you the core equity premium.
So do you want to take a minute and go into how you manufacture that profile?
Sure. So we're doing this purely in an option-based overlay. So we start with a 98% investment in a core U.S. equity ETF, low fee, very efficient, all that. And then we're overlaying. So let's just do we have three products. We have product that's trying to add convexity on the downside and the upside. It's a symmetric. Then we also have a product that is trying to add convexity just on the downside, so trying to cut off the left tails only. And then we have a product that's trying to add to the right tail only, which is our upside convexity product. So let's just take the downside product as an example in terms of what this option overlay would look like. Basically, we start by saying, what do drawdowns generally look like in markets, and how can options be used to help mitigate them? And so we basically do a clustering analysis of what drawdowns look like. And we've identified two horizons and magnitudes of drawdowns in history that are most common. And then we're buying really deep out of the money puts that'll help hedge against those types of market drawdowns. And then we have a bunch of strategy components that help really effectively create those modified distributions. We'll monetize options early. We'll roll them before expiry. So there's a lot of components that go into the strategy that really help effectively create those modified distributions. So we're really thinking of options as like surgical blades, where we're trying to take a core risk premium that everyone loves and knows, and we're trying to carve up the return distribution and take weight out in certain places and then add it to other places.
So are you selling options and to fund the purchase of other options, or are you expecting there to be a general sort of rolling cost in terms of the purchase of option premia in order to fund these different distributions?
Exactly. We're not selling any options. We're not capping upside or capping any direction. We're spending a set 2% annual budget on the entire overlay.
Gotcha.
And so when you're talking about the symmetric product, we're spending 1% a year on both sides. And if you're talking about just the downside or the upside, we put the entire 2% into the option overlay for the one side. And so, as long as the math works out that the amount you're spending, you can add enough value during those extreme moments when convexity is really valuable, then you should be in good shape.